We were talking in an earlier segment about capital investment in refineries, which oil company executives are loath to do. So why isn't there more capital investment in this country? What are we doing politically that dissuades this, which is the opposite of persuade? Well, one thing we're doing is we get really low interest rates, folks. We were talking about the cost of housing and mortgages across Tampa Bay. And here's what's so interesting. I want to get back to that real quickly. Let's talk about interest rates. What are interest rates? Well, they're a very important signal to the economy because when interest rates are low, people think it's a good thing to borrow more money. When they're high, people think it's a good thing to save more money. And we have been involved in basically a 40-year unprecedented experiment, not just in America, but in human history, in the whole history of the West. We've been involved in a 40-year experiment since about the early 1980s in radically lower and lower and lower interest rates. In fact, they got so low, they got so little, they got so squeezed when COVID came along, you almost couldn't see them anymore. You need a microscope to see interest rates because the nominal interest rate set by the Fed, it's called the Fed funds rate. There's a little bit of complexity to that. That's an interbank lending rate. But nonetheless, the Fed funds rate is generally the baseline. And assuming you're a prime borrower, you're going to pay a couple of percentage points over that baseline rate because the banks have to make some money and account for their risk in lending you some money for your mortgage and that sort of thing. And if you're a subprime borrower, well, you're going to pay more than that. So for the last 40 years, what the U.S. Federal Reserve has done, and especially really Western central banks in general have done, if they pushed interest rates down and down and down and down and down. Now, if you're old enough to remember the late 70s, early 80s, you will recall, as I mentioned earlier in the show, hey, I had to spend 17, 18% to get a mortgage or a credit card or a car loan back then. And that was a lot of interest, folks. That adds up quick, and that ends up being half of what you're paying. But, you think, well, that's a bad thing, right? And you think, well, today you can go get a mortgage as a prime borrower, maybe 3.75%. That's a good thing, right? Because it costs people less, and those greedy banks make less money and this and that. Well, it's not so good if you're a saver. Because here's what's so radically different about our economy today, which I think all of us, whether you follow economic news or not, I think all of us feel it, right? And there's a feeling that things aren't firm. They're not built on a solid foundation, that the economy is shaky. And that feeling, I think, is awfully hard for the Biden administration to shake, even if it's subconscious almost. People just sense that there's something wrong. And then some people, of course, spend all their time, like me, reading about politics and economics and trying to be informed as best we can be. And we like to think that we know that something's wrong. But nonetheless, if you go back to 1982 and you say, yeah, I had to spend 17% on interest for my mortgage. But here's the thing. You could get 14% at the bank on a simple savings account or a simple CD. So if you weren't a borrower, if you were a saver, if your house in 1982 was already paid for, let's say, or mostly paid for, you were an elderly person, you could simply be thrifty. You could simply be thrifty and stick money in a safe bank account, FDI insured, as safe as it gets, let's just say, or a simple 6-month or 1-year CD and get 15% on it. You didn't have to be some financial whiz. You didn't have to go out there and worry about your money all day. You didn't have to go out there and think, well, which FANG stock am I going to buy? Let me look at Tesla. Do I need to buy Bitcoin? What do I got to buy to beat inflation, right? I mean, you could just simply go buy a simple, safe investment because you could get 14, 15% on a savings account or a CD, folks. And yeah, inflation was high in the late 70s and early 80s. It's probably about what it is now, 7-8%, depending on how you calculate it. And they've monkeyed with that. So I would argue it's actually higher today. But let's just take the official numbers, which are about 8.6 today. So yeah, inflation was 8%, late 70s, early 80s. But if you were saving money, you could get 15% simply by being thrifty, by not spending your entire paycheck, let's say, putting some of it into a bank. And that's a remarkable thing when we think about it, the magic of compounding interest. I know for a fact my grandparents simply were very, very thrifty. They weren't particularly invested in the stock market. I think late in my grandfather's life, he started to get into a few stocks. He was a very modest, modestly paid person with a modest income. And I remember as a little boy, they had a party back in the old-fashioned days. This would have been the 70s when I was little. And they burned their little piece of paper from the mortgage because they'd paid it off. A poignant memory from my childhood. And I remember my dad telling me later, they actually made a mistake paying that off because it was a fixed rate. And they should have, instead of paying it off quickly, they should have been investing some of their monthly mortgage interest payment. And that investment would have grown faster than the interest they were paying on their mortgage. But, they were old-fashioned, and that was the thing. You wanted to be out of debt. They were Depression-era folks. And that was a goal. And God bless them, they did it. And they did it simply by being thrifty on one income. And this 40-year experiment we've been engaged in, we, meaning the banking class, let's say, and the political class, of pushing interest rates down and down and down and down and down and down and down until they were basically zero. And in places in Europe, they're below zero, even nominally. Right? There are euro bonds, both government and corporate bonds, which you can go buy. I don't know why you would, to pay a negative interest rate. You pay, you lose some of your principal every year for the privilege of owning that bond. Not my kind of investment, but nonetheless, if that's the least dirty shirt in the laundry, I guess, people lock in their rate of loss for the period of the bond. And say what you will about Treasury debt, you can still buy U.S. Treasuries now, the 10 years up above 10% now. At least you get a positive yield nominally. You can make interest. You can make 3%. But here's the thing, folks. If inflation is 8%, that's what they say. I think it's higher. But let's just say, for sake of argument, if inflation's 8% and you're getting 3% on that 10-year Treasury, you're losing 5% every year. Okay, that's the real interest rate. So they can be raising rates, and the real interest rate can still be going down. Do you understand what I'm saying? So if you take the real interest rate equals the nominal rate, the rate you're getting paid, and now it's 3-point-something% on that 10-year minus inflation. So the nominal rate minus inflation, that's your real interest rate, your real rate of return. And folks, right now that's negative on U.S. Treasury debt in inflation-adjusted terms. Now, don't get me wrong, there's still a huge market out there for Treasury debt. I mean, we've seen the Fed is happy to buy up Treasuries from commercial banks. They did a huge round of it after the 07-08 crash. Remember, quantitative easing, QE, that was basically buying Treasury debt and some other debt, which was worse, mortgage-backed debt, but buying Treasury debt from commercial banks and recapitalizing them, giving them money in exchange for it. And boy, they've done it in earnest over the last couple of years with COVID. That was a big part of monetary policy, was once again buying up Treasury debt. So the Fed provides a market for it. And all across the world, people own U.S. Treasuries, pension funds, sovereign wealth funds, various governments, a lot of government central banks, other than our own, own huge amounts of Treasuries. We hear about the Chinese owning our debt. Well, that's somewhat true. The Chinese central bank owns a lot of U.S. Treasury debt. And so sometimes certain pension funds, private equity funds, et cetera, are actually required by their charters to own a certain percentage of U.S. Treasury debt. So there'll always be a market for this. But you're getting paid a negative interest rate on that. And that's about the safest form of investment we can think of as U.S. Treasuries. Other than just holding cash, if you just hold cash in a CD or a money market mutual fund, let's say a ready checking account, or in your local bank, in some sort of checking or savings vehicle, that's not even getting that 3% on U.S. Treasury. That's probably getting 1%, maybe less than 1% now, but again, inflation's 8%. So you're losing money, folks, and this is all the result of this 40-year experiment in pushing rates down and down and down and down. And the idea is that the lower the interest rate is, the more people will spend money. The more they'll borrow, the more they'll spend. They'll buy that $700,000 house maybe instead of that $400,000 house they should buy based on, the realities of their income. Maybe they'll buy that Lexus instead of just buying that Ford Taurus. Maybe they'll go to Europe instead of just buying going to Disney in their car, right? I mean, we can imagine the ways in which low interest rates filter across society. And they tell people don't save money, at least not the old-fashioned way, because you're losing. Savings is for chumps. And borrow money because that's what smart people do. And right now, there's a great case for going out there and borrowing as much as you can. I'm not advising that, but there's a case for saying borrow as much as you can if you can get it at 3.5%, let's say, a little under 4%, and get that fixed. And then inflation's 8%, go buy something that'll keep up with that. It's not so easy to figure out what that is. Is that gold? Is that some stock like Tesla? Some hot stock? Is that commodities, which are having a resurgence? Is that Bitcoin, something speculative? I don't know. If I knew, I wouldn't be on the radio talking to you. I'd be out there doing it. But nonetheless, it's important to understand how important it is culturally what low interest rates do to a society, what they do to people's incentives, what they do to their natural desire to put money away and save for a rainy day, and maybe even beyond a rainy day, save for their kids and grandkids, to have what they saved last longer than their lifetimes, so that their kids and grandkids will be better off. I mean, this is the most natural inclination. This is such a human inclination, right? When you loan other people money, you expect to be paid for it because you're taking a risk they might not pay you back. We're not doing that, folks, and it has huge ramifications.
Thank you for listening to the Morgan Streetman Show. We hope you enjoyed what you heard, and if you did, please click like and subscribe to help us out. And remember that we recommend that you exercise your brain at least once a week.